Thank you to all of you. It's great to see good friends and new friends coming to this 41st statement of the Latin America Committee on Macro Financial Issues. This time our topic is Mexico. The committee, as you know, meet for 2.5 days and deliberates on an issue that is of relevant importance to the region. And this time we chose Mexico. And if you see the invitation, we have changed the title. And the reason, and we call it Solving Pemex for Solving Mexico, is because, as you will see from my brief presentation, Pemex is to us kind of at the core for allowing Mexico coming back to a path of sustainability as well as to economic growth. So the way we usually do this, and we're repeating this one more time, is that I will make a summary presentation of the statement that you all have. Then few of the members will join, others will be sitting in the audience, and we will have a discussion. So first, a background. Mexico doesn't look really well over the last 25 years in terms of economic growth. Actually, has been one of the worst performers in Latin America. And this is, of course, long-term, right? 25 years. And one of the major reasons has been very low productivity growth. If we look at the current situation, now economic growth has halved to around 1% in 2019. And this is attributable basically to both declining investment and consumption. Now, that is a characteristic of Mexico in terms of economic growth. And it's kind of a puzzle because since the 90s, Mexico has been making a lot of progress in a number of areas. Has adopted flexible exchange rate, consolidated central bank independence, has a much more deeper currency-denominated debt market relative to other countries in the region, has been able to maintain, let's put it, good current account balance, and also is being most integrated than any financially and trade integrated to the global markets, but especially to the United States and many of the other countries in the region. So all these things don't catch up with the actual performance in terms of economic growth. So the new AMLO administration has that background in terms of the past, but is also facing a number of external challenges that will combine, as I will show in the next transparency, with other additional domestic challenges. So on the external side, we all know that external growth is actually slowing down. And particularly important for Mexico is that the US, the forecast for growth is now in the 1%, in the range of 1% to 2% for 2020, with a forecast for 2,500 for this year. Also, we know that there is expectation that the Fed is going to cut interest rates. But of course, that is going to translate, given the very high interest rates in Mexico, and now expected lower interest rates by the Fed, that is going to incentivize additional carry trade. Of course, I don't have to tell you too much about the US protectionist and migration threats, which are, of course, complicated the external environment. So we have macro issues as well as political, social kind of issues coming from the external environment. Now, add to that AMLO's domestic challenges made in Mexico. So after NAFTA, there was huge expectations about, well, now Mexico is really going to grow fast and develop, and those expectations did not materialize. Actually, out of the growth that you have observed, 2.5% average growth since NAFTA, most of that growth is attributable to the increase in population. Basically, little from investment and nothing from productivity. So we'll expand later on during the discussion, but our assessment is that this lackluster growth is basically due to a significant and growing numbers of microeconomic distortions that actually even tax employment, okay, but a burden on hiring. But we'll expand on that later. Again, I don't think it's nothing new for you to know that the chronic deficiencies in crime, corruption, and the very weak rule of law in Mexico. Now, what has been the response of the new president to this full package? Well, basically, with expected an actual decline in economic growth, there has been also a decrease in collection of taxes, and the response has been, okay, let's cut expenditure. That's fine on the one hand, but on the other hand, most of the cut of expenditure has actually been reallocated to public expenditure to boost the role of a state, since AMLO's development program is actually to increase the role of a state in sectors like energy, infrastructure, and development. I don't know if the chairs are cutting it, well, but there are other screens there. The problem with the cuts that have been across the board, and without really an assessment or, okay, where do I cut in terms of what is less productive, what is wasteful, instead is across the board. Those cuts have affected public sector employment and wages, and actually have involved the canceling of important infrastructure projects that were underway. One of them is the Texcoco export, which has been in the news so much. So we come to the heart of the problem, or what we believe is the heart of the problem, the Pemex situation. We start saying that by far, Pemex is the most important fiscal problem in this current administration, for a number of reasons, right? Lack of investment in exploration and extraction, the increased reliance on debt for the financing of Pemex operations. And this is being reflected in the market, as I'm going to show you in a second, as investors are actually getting concerned about holding Pemex bonds. And these bonds have already been downgraded to what is called junk bonds. Okay, so, and this has allowed for a spread between the debt of the sovereign versus the debt of Pemex. In other words, at this point, the investors and the markets are differentiated between sovereign debt and Pemex debt. And so there is a difference of 100 basis points in the spread differential between Pemex bonds and sovereign external debt. So this is what the market is saying, okay? What I'm saying now is what the numbers are saying based on looking at market behavior. And the market is actually pricing two things in a different way. First, in terms of assessing the sovereign, the government of Mexico, the markets are maintaining a favorable assessment. The view right now, or the expectation right now, is that the AMLO administration is going to continue with the current macroeconomic framework that I described as, well, you'll keep the fiscal stance in balance, you will keep central bank independence. So that's what the market is pricing in right now. So let me show you, rather than going into this, let me show you something different that the market is also saying. So on the one hand, some indicators, some market indicators, and perhaps I show you first the picture. Let me see. This is what I was trying to say in terms of how the market still believes in the sovereign. This is a graph of the credit default spreads, and basically reflects the probability of default that the market is attributing to a default of the sovereign. And what you can see is that this spread has declined, right? So the expectations of the probability of default has declined, okay? That's on the one hand. On the other hand, however, there is a number of other indicators that are telling a different story. For example, Mexican equity markets have been selling off on a continuous basis. So the equity market is telling a different story because the equity markets reflect expectations about economic growth, okay? And so some data that I don't want to complicate too much with explanations, but I'm going to show you in a graph, the price to earning ratio, which basically shows the valuation of Mexican assets, has actually declined significantly from a peak in 2016, and I'll better show you that in a graph. But basically what they are reflecting, as I was telling you, is a decline in economic growth, and that is hurting forecasts and expectations about Mexico. It also reflects the downgrade of Pemex to young bonds that I just mentioned, but also very recently, last month, because we're in July now, Standard & Poor's and Moody's downgraded the outlook, not yet the actual category, the rating, but the outlook for the sovereign to negative. So there's expectations of a downgrade of the sovereign debt now, okay? So I told you I was going to show you another graph, and this is what I'm talking about now. This is what has happened in the equity markets, and you can see that the Mexpol is the stock exchange in Mexico, and reflecting lower growth, this has been declining on a sustained basis. But also, and I think you're going to appreciate this picture, I was telling you about price to earning ratios. The important thing is that this reflects the valuations that the market is giving, and that's all I want to focus on. But it's comparing three countries. It's comparing the green is Mexico, the blue is Brazil, and the red is Argentina. The central point here is that with this increase, that means that the expectations of valuations in Mexico are actually good, okay? So this is showing that while Mexico and Brazil were declining from 2010 to 2015, 16, Mexico was actually going up. This ratio was going up and actually reaching the levels in the United States. In recent times, however, look what has happened. Mexico's price to earnings ratio has declined, and now they converge to Brazil and Argentina. Okay? So, if we have this full scenario, no wonder that we are so concerned about Pemex situation. So our first line of attack, or recommendations for a first line of attack, is that Pemex actually needs a detailed action plan to address its weak financial situation. And we are calling for a bold corporate restructuring of Pemex. And this involves a number of actions, right? First, as any normal restructure or trying to improve the health of the company, you need to cut operational expenditures in order to raise the company's earnings. Restructure corporate governance and manage. There is a need to redirect savings made from the cut in operational expenditures to research and development in where the oil is, which is deep water and natural gas explorations. And central to all this is have a broad asset and liability management, which basically, and this is what is kind of the core of the action, is selling some of the non-core activities of assets, Pemex assets, to allow for a significant reduction of debt. Now, that's not enough. We think that there is additional actions that need to complement this, what I just mentioned before. And again, I'm just mentioning them. We can have a discussion of all this later on. Well, reinstating the role of the Commission of Hydrocarbons. Reinstating, it was there before. So it's reinstating is an additional recommendation that we have in mind. There has been a number of cancellation of contracts with the private sector, and we are saying reconsider that cancellation. We don't think it's appropriate for a company that is facing the financial problems that Pemex is facing. There is a number of new projects that have been proposed, but they are poorly planned, and there has not been really a cost-benefit analysis that warrant the actual implementation of those projects, and especially the Dos Bocas refinery. And of course, given the financial constraints of the government, it's necessary to attract new private funding for investment in exploration and structure. So in our view, if these things are not done, Pemex is basically what we call a collision course that might lead to a debt restructuring arrangement, which of course, it could lead to a contagion to the sovereign. And if moved below investment grade, which is where the country is right now, is at investment grade, there is something that characterizes institutional investors holding of assets from foreign countries. And is that in their internal management of their asset allocation, pension fund, mutual fund, and other institutional investors have to sell, because of their internal regulations, they have to sell assets that are below investment grade. So a move of Mexico below investment grade could be a catastrophe. So finally, basically what we're saying is that the government right now has met its primary balance goal by offsetting because of the reduction in economic growth, folding revenues with across the border expenditure cuts without really assessing which cuts are better than others. If primary surpluses are going to successfully be used to finance public expenditure, well, the first thing that any economic or investor would say is to have a well-developed feasibility studies for any project that we're going to embark. It's not just this refinery or this airport or whatever. It has to have a feasibility study. From that perspective, I just mentioned the Dos Bocas refinery, but we also have the Maya train, the St. Lucia airport, and we have not been able to find those feasibility studies that warrant implementation of those projects. Again, we said there were projects that were underway, like the Texcoco Airport and the Toluca-Naucalpan Highway, that were well advanced, that have been canceled. We again have not seen documents sustaining that those projects were inefficient, were not properly chosen. So, concluding, Pemex is, in our view, in a collision course that might lead to a debt restructuring agreement that could actually contaminate the sovereign. And therefore, a detailed action plan is needed to restructure the company and to increase the amount of exploration that are feasible, viable, and profitable. our recommendation then is a bold corporate restructuring, but again, that would not be enough if all the other expenditure projects that the government has in mind are not done without a good and strong feasibility studies. Okay, so that's the bottom line of our presentation. Now, let me tell you before I ask my colleagues to join the podium that this statement has been produced by the following people. Laura Alfaro, she's sitting right there. I don't have to tell who they are, not only because you know them, but also because they are in the invitation, so the description is there. Guillermo Calvo, Augusto de la Torre, Roque Fernández, Pablo Guidotti, Paulo Leme, Enrique Mendoza, Guillermo Perry, Carmen Reinhardt, and myself. So you have a group, some more than others, but extremely credible group of people. All right, so I would like to invite some of my colleagues to please join the podium. And before asking them to complement what I've been saying, we also discussed during our meetings another possibility for dealing with Pemex problems. Not only this corporate restructure that's the alternative we're presenting, but also we had plan B. Because what if, remember that the AMLO administration is not very fond of privatizations. And we're actually calling for privatizations here, right? Selling assets. Well, selling assets sounds better, but still you're selling it to the private sector. So, okay. So what if that is not being done, right? So still the debt problem in Pemex remains. And perhaps it's time to consider a refinancing of that debt. Will that have problems for the sovereign? Can this be done? Well, we have an expert on debt in the committee, and that's Carmen Reinhardt. And I would like her to say just a few words on this plan, what we call Plan B, how to refinance Pemex debt. Carmen, could you please take the microphone?
Well, it's really not discussed in the document, but basically the message is if the market approach isn't followed through, if AMLO or the government in general is not receptive to a plan that requires the government to divest itself of assets and try to engage in very market-friendly solutions, then Plan B is need not happen immediately because Pemex financing plans are covered in the next couple of years, but then you have to start thinking whether the problem of Pemex is illiquidity or insolvency. Some deem the problem to be more of an insolvent nature, and there's a debt bulge not in 2019, not in 2020. Those years are covered, but in 2021 and beyond. So the Plan B is basically you start negotiating a restructuring of the outer year debt for Pemex before the government takes on fully Pemex, i.e. before it becomes a sovereign problem, so that it is a sub-sovereign debt restructuring, not a sovereign restructuring.
Okay. Thank you, Carmen. Okay, so now I'd like to ask my colleagues to complement or to add or to clarify or to correct me. I might have interpreted the whole thing wrong. So, Paulo?
Sure. Well, first of all, it's a pleasure to be here. I'll make two types of comments. One in terms of just a general market reading and how often markets take a long time to see deterioration in fundamentals. And second, go to the core of the Pemex problem from an investment banker's perspective. In terms of the market indicators, I quite find it striking. I mean, in terms of how nothing of what we have said, it's really priced. I mean, particularly in what I consider to be the most dynamic, first to price FX market. I mean, as we discussed, I mean, the peso anchored by very high real interest rates and also the FSL from the IMF, also the new NDF intervention program of 20 billion of Banco de Mexico, which is huge. You see very little activity that's within normal ranges in open interest in Chicago futures. So you don't see anybody really taking the other side of the trade on Mexico or betting against the Mexican peso. But you know, when you look at all the other movements, I mean, the deterioration of Pemex, when you look at you know, some of the policy signals being given by the administration, potential external shocks, I find that you know there should be you know some repricing already taking place. But normally that's exactly what happens to markets. I mean, it's like when they wake up one day, they would see it. I also find it very striking that normally lethargic rating agencies are seeing it first. And, you know, and the actions by Fitch are particularly very harsh, already bringing the sovereign to BBB, all of them in negative outlook, downgrade to Pemex to junk bond territory. But a very unusual language on the S&P statement regarding the negative outlook is that within the next 6 months, there's a third probability that we could downgrade the sovereign already. So there's still 2 notches to go before becoming junk bond. But I would say I find the discrepancy between markets being extremely risk-on everywhere. Anything that has 1 basis point of yield in the planet is considered to be worth to be in your portfolio. So therefore, I think that reduces the degree of scrutiny on the deterioration of the sovereign fundamentals that seems to explain this apparent paradox. But as I said, I mean, being extremely sensitive to growth, the equity markets do price that very significantly. That's the first point. The point in terms of Pemex, I'm not an oil expert, but I've worked with several oil companies when I was an investment banker as a client. I mean, it seems to be a worthy asset. It's a worthy company. I mean, just maybe it's not liquid because, you know, the net worth is under the sea in a couple of miles under the ocean, and you need engineering to develop that and to extract that. But I don't think that solvency to me is really the issue for Pemex, at least for now. And therefore, it's really much more like a classic, you know, reorganization or corporate, you know, reorganization of the company that will go all the way from management, really investing very heavily in engineering, substantial controls of OPEX, operational expenditures, headcount, wages, admin costs, but particularly controlling also theft of product that reduces significantly revenue. With that, you can really, and it's identical to the analysis of debt stability in a sovereign. I mean, EBIT is identical to the primary balance. So basically what you need to generate is savings. You redirect that to capital expenditures, to CapEx for investments, research and development for deep water oil exploration. And the ability, therefore, to see within 2 to 3 years a response in operating revenues, I think, is very highly likely. And as soon as you do that, all your ratios very quickly start to improve. Taking a proactive on the liability side, liability management side, I think it is possible. But I would say the financial markets usually respond very well when you have a very well thought out strategy, you know, to be able to tackle all these issues of production, revenues, and the solvency of the company. For me, being a Brazilian, it's inevitable not to strike a comparison with Petrobras. I mean, I was very closely looking at Petrobras back when I was living in Brazil, when exactly the whole thing blew up. And it is really striking, I mean, some similarities. I mean, what looks like to be very well-intentioned developments in refinery right now was exactly one of the pillars of the PT administration source of funding, corruption in very ineffective products that didn't generate results, except on the construction company side and also on the political side. And that I would say, it's very worrisome, the choices of investment that they're making, when I think that there are better choices as well. The second striking thing is that as the situation deteriorated and the levels of debt of Petrobras were significantly higher, admittedly, than Pemex, but not of such a totally different scale. And I was actually talking to one of my friends today about the banks seem to be very happy to roll over the debt. Well, the banks are your friend until they're not. And the day they're not, they really pull you off completely off credit. And just basically the game that you have to be on the line. You have to be ready, to take the debt deals, to have the capital market transactions. And I think that that's exactly what happened to Petrobras. I mean, it was like from one night to the next morning, Petrobras was completely off credit. And it was a company that was solvent, I mean, incredible assets in subsalt. And all of a sudden, they couldn't even roll over maturities in the short term. Then that contagion from the quasi-sovereign to the sovereign was very violent, and then immediately contaminated Petrobras spreads that exploded above 700 basis points. That goes immediately to the sovereign that went from 200 basis points to CDS, or the credit default swaps, to almost 600 basis points. So it really followed Petrobras. And there was essentially no credit access for Petrobras at all, anywhere. And the type of proposals, I mean, that Petrobras was receiving were absolutely incredible. I mean, there were offers of credit lines, what we call secured lending, 10 billion lines, $15 billion lines. But I mean, with haircuts, meaning that basically haircuts of 50 to 60%, 65%, that they would lend almost like under usury laws. It was like just incredible, right? Then they finally did what we're discussing here, which is change management completely from top to bottom, change the board, change the heads of engineering, department heads. They presented a credible medium and long-term reorganization plan for the company. That plan basically revisited what was their comparative advantage, working from upstream all the way to downstream oil activities, and then identifying a lot of valuable assets that they really shouldn't really have comparative advantage, like, for example, even in gasoline distribution and retail. Those are very valuable assets. Logistics, pipelines, gas, oil pipelines, transportation. And they started to sell a lot of those assets to knock down debt. And as soon as they had a credible plan, they went basically back to the markets, and the spreads melted down completely. So all the pressure that you saw on Petrobras spreads evaporated like a petroleum distillate. And then it got basically transmitted into the sovereign, and then the exchange rate that responds to CDS also recovered. And then once you had a plan, it was well implemented, and it looks, now that they are back into life. So I think that those lessons, I think, are important to be applied to Mexico.
Thank you, Paulo. Now, Enrique Mendoza, in addition to being a great economist, is also Mexican, which is an important characteristic. We wouldn't have done a statement on Mexico without a Mexican. So can we please have your...
Thank you, Liliana. I guess I take the blame then for writing a report on Mexico.
Part of it.
So I want to make three points, which reflect also my expertise, I guess, being Mexican. I think the government of President López Obrador was elected on a mandate for three things. which have to do with corruption, with crime, and with income inequality. Those are the reasons the president is in power. The president is not a new figure, it's an old figure in Mexican politics. His positions that we now see him trying to bring forward as acts of policy are positions that every Mexican has known for the better part of 20 years. So the fact that the Mexican electorate gave him a landslide victory this time is a reflection of the exhaustion and the tiredness in Mexican society with the issues of corruption, the high crime rate, the violent crime that you see in the Mexican newspapers every day, and the problem of inequality. We have tried policies of the left for many decades that did not solve those problems. We have tried policies of the right for many decades that have not solved those problems. So really do wish him success in and I think the committee probably does too, in tackling those problems. If he just handles one of them, it would be a terrific change for the society. Probably the diagnosis differs on the way I think about those problems. I think there is an institutional weakness, an infrastructural institutional weakness in Mexican society, in the Mexican government, particularly in the judiciary, and I don't see many of the current measures in Mexico that are really going after. Liliana was talking about the problems in the microeconomy, the problems in the enforcement of contracts. At the core are some of the reasons why there's all these distortions similar to taxation, or effectively like taxation. And I think at the core of that is, again, these institutional weaknesses, which I acknowledge are very difficult to attack, but I don't see them as being the center of the plan. There is a global development plan. The government presented this global development plan. The Congress approved it. The global development plan, and that's also partly reflecting the focus we've given on Pemex, the global development plan puts the central focus of Mexico's development over the period of this administration on the energy sector, and specifically on the oil sector. So one could start by questioning whether that's a good idea or not, and maybe that merited some discussion, whether at this point in the structure of the international energy market it's a good idea to do that. But that trend is gone, because that is the development plan. So I think it was a good idea for us to then focus, so let's try to make that work. If you want to try to make that work, then you need an oil company that works. And again, this is an issue where we might differ from. Development plan is mostly rhetoric, but where it tends to be precise about these issues is double betting on the oil sector without really addressing the key structural problems that the oil company has financially. And these are problems that can bring it down, and they're very important. And there is a lot of political undercurrent against a lot of the reforms that were done in the previous periods. In the energy reform in particular, as a reform was a good reform. The fact that there was a lot of corruption on the implementation, a lot of things, that was a bad thing, of course. But in the terms of the economics and the principles and a lot of the issues that Paulo mentioned will be tackled with the oil company, are issues that the existing reform was trying to tackle. So when we say reinstating the role of the Commission of Hydrocarbons, when we talk about the contracts for exploration and the contracts for production, when we talked about divesting assets for the distribution of gasoline, these are all things that were part of the energy reform. The energy reform is polluted by this notion that it was done by these neoliberal governments and the corruption. Setting it aside, I think it's a bad thing. Making sure that it can be implemented without the erosion of corruption. It's important, and it would be a good thing. So the last point has to do with financial vulnerabilities. I think also closing the connection between these three things. Financial markets are fickle. Okay? So Paulo was also mentioning, numbers may look good. So as Liliana mentioned, you look at some of the numbers, you look at the CDS of the oil company, things don't look bad, but financial markets are fickle. The reason we call sudden stops is because things look good until they don't. And one morning you are the star of the OECD newest member, and the next morning you have a debacle in the peso, like we did in 94. So there are some signs of fragility. We were pointing to the stock market. We're pointing to the spreads of the oil company versus the spreads of the Mexican government. Those are signs that are telling, yes, the markets are in a honeymoon status where they're willing to play ball, but they're sort of waiting to see what of all these policies will actually translate into actual action. What of all these policies will actually make the oil company financially healthy and will make it work. Just very recently, there was an agreement with bankers to renew revolving credit lines, which is important, but $8 billion in the context of a debt of 110 is a small amount. And what we need to worry is about the big stocks rather than the small flows. And then finally, also about the credibility of the institutions. So I think we will be very careful with the fact to reform and dismantle the corruption apparatus that exists in Mexico to strengthen the judiciary, and at the same time preserving the credibility of the institutions that exist. And at the core of these institutions is the central bank. And the government so far has been very careful, because so far hasn't found itself too much in a collision course with what the Bank of Mexico has tried to do. So just like is the case in the United States, we'll have to wait and see what happens when the opinions diverge between what the administration thinks is best and what the Bank of Mexico thinks is best. I think it took a long time to build the institutional infrastructure in Mexico at places like the Bank of Mexico, the Federal Electoral Commission, the Supreme Court. I think those institutions in Mexico have gotten better, and not undermining their credibility with actions that can undermine it is important. So that's the
Okay, thank you so much. Okay, we heard the Brazilian investment banker, the Mexican academician. Now, why don't we hear from the Argentinian, who has also been both, right? An academician and a policymaker. So Pablo, please.
Thank you. When I was coming in the plane here, I was reading the latest, the last staff report from the fund, and getting the impression, sort of a very simple view on Mexico, that first of all, the history and all the reforms that Mexico had done were tremendous, and the initial conditions were great for AMLO, and that it was great also that AMLO seemed to value fiscal prudence. And so, you know, the future looked bright. And I think that the main message that we are transmitting with this statement is actually that neither of those two things are actually so clear. First of all, that the initial conditions in terms of fiscal risks are much more risky than what maybe the market is realizing, that there is a growth problem which lies at the basis of development and at the basis of fiscal sustainability, which has a lot to do with microeconomic distortions. And that if the economy falls down, or if the economy hits a downturn as it is, this is not going to be solved by Keynesian fiscal stimulus and by spending in infrastructure, okay? Because the problems are not problems of government expenditure, okay? But are addressing the microeconomic distortions that have led to zero productivity growth. Then, when we look at the issue of, well, it's good that AMLO respects or has pledged fiscal prudence. Well, yes, but what that does imply for fiscal policy? That essentially we are seeing a lot of wholesale cuts in expenditure and cancellation of programs which have been studied, analyzed, and they seem to be an example of quality spending, and they are being replaced by other spending that that is not clear, that has a background in terms of feasibility studies. So we are seeing that this objective of keeping fiscal prudence is actually generating maybe a decline or a decrease in the quality of government expenditure. Then there is the issue of debt. Okay? Mexico starts with a 53% debt to GDP ratio, okay? which by my standards, by Carmen's standards, is actually very high debt. Many people think that is adequate, but my impression is that for emerging market or developing economies, these numbers are actually high, and especially high if you hit a downgrade that puts you in non-investment grade status, okay? And in this regard, when we looked at in more detail, two things appeared, that there is significant amount of debt that is supposed to be used by Banxico for open market operations that is not really included in the debt statistics, which would then bring debt statistics to a higher level. We see that there is a significant amount of debt that is dollar or is denominated in foreign currency. And then we have the risk of Pemex. And this is a financial risk and a fiscal risk in terms of maybe the easiest way that AMLO will pursue is just to guarantee outright Pemex debt. And in those situations, really, I think that the possibility of a credit downgrade and a significant increase in spreads on Mexican debt is something that we may perfectly see in the not so distant future. So I think that for me the message of the statement is this issue about being cautious about how we interpret the initial conditions, being cautious about how we design a policy response. The issue of growth is not an issue of Keynesian response in terms of government expenditure, but has to do more with structural reforms. And in this sense, what appears to be fiscal prudence, it may be actually unsustainable and maybe reducing the quality of expenditure. The fund is actually seeing part of this and is recommending increases in taxes. And we don't think that is actually the way to go. So maybe this is sort of an overview.
Okay, full disclosure, everybody sitting in this panel has worked for the IMF, as well as a number of the other members that are sitting in the first row. But Augusto, I said most, yeah. But Augusto has a unique characteristic also with Guillermo Perry, that is that he has also worked for the World Bank. So Augusto, maybe you could focus on the micro distortions that we raised.
Yes, thank you very much, and thank you for joining us on a 4th of July week. One topic that cannot be downplayed in the case of Mexico is that Mexico has had 30 years of very low or non-existent productivity growth and has a very severe growth problem. And one has to recognize that that's somewhat of a puzzle because of several reasons. First, Mexico has been perhaps a star in Latin America as a country that has managed up to now their monetary and macroeconomic and fiscal issues relatively well. It has earned the status of an investment grade country. It is one of the earliest ones in Latin America to do so. And it is of the larger Latin American economies, the one that has most successfully shifted towards an outward-looking growth strategy. Mexico liberalized its external sector in the late 80s, and then underpinned by NAFTA was able to create a very strong exporting sector, highly diversified, which had a very fast growth initially until it was slowed down when China entered into the global scene. And one wonders why such a major expansion of the exporting sector and diversification of the exporting sector was not able to pull the economy in a more dynamic way. The growth in exports in Mexico can be compared to some of the growth in exports in Southeast Asian countries. And yet there was not enough traction and domestic response to that. And that has been a major question for research in Mexico, trying to understand why this weak domestic response. Particularly considering that when one looks at the international experience, dynamic exports have typically been the most important highway to growth. Now, Mexico, of course, benefited, some regions of Mexico, of course, benefited from the expansion in exports. And the northern parts of Mexico have become very dynamic. And if you just look at those regions, you have Asian-like growth rates. But the rest of the country has not become involved. Understanding this is crucial to understanding the growth problem in Mexico. And one thing that concerns the committee is that it seems that the new administration in Mexico may not be paying enough attention to the reasons, to the underlying reasons for this lack of growth, and is trying to do something that we tried in Latin America to do in the 70s, which was to increase the role of government investment and government presence in key sectors and see if that can pull the economy out. It's doubtful that that will happen. And we had a lot of discussions in the committee on possible ways of explaining this lack of this growth problem in Mexico. And the one that comes out very strongly comes out of the work of Santiago Levy. And it's very well documented, the fact that in Mexico you have a very wide distribution of productivity across firms. One typically would expect that the distribution of productivity doesn't broaden because through resource reallocation, resources should move to more productive areas and the productivity dispersion should rather narrow as the economy modernizes. But in Mexico, the distribution of productivity has actually been widening. And the low productivity sector, the less dynamic sector, is actually attracting more and more labor and more capital. So it's like Schumpeter in reverse. Why is this happening? There are at least two very convincing explanations in my mind. One is Santiago Levy's view that there is a tax and transfer system in Mexico that's tilting things in favor of moving resources to the low productivity sector and against moving resources to the higher productivity dynamic sector. The more dynamic sector is heavily taxed. Labor taxes in Mexico are among the highest in the region. And at the same time, because of the lagging part of the economies in the low productivity sector, there has been a policy decision to actually subsidize the staying in that sector by providing incentives to remain informal, for instance, through pension and medical benefits. So that creates a significant misallocation problem that may be dragging the economy down. And that has to be fixed through things that are important micro reforms, tax reforms, regulatory reforms, that are very different from the current approach of the government, which is shift resources to the energy sector and the public presence there. But the second, I think, reason for that is the one that Enrique was mentioning. You know, Mexico, the bet Mexico made in growing in an outward-looking fashion by integrating itself to the larger markets, particularly the US, requires a very fine-tuned contract enforcement system. Because for firms to integrate to the dynamic sector, you have to have ease of contracting, of delivering goods, of moving goods, of enforcing contracts, etc. And it seems that judicial problems and contract enforcement system make it very difficult to integrate the markets and enforce the contracts that markets need across Mexico's geography. So that creates segmentations in all sorts of markets and impedes the integration into the more dynamic parts of the economy. So those are heavy agendas, deep agendas that require kind of a steady trial and error reforms on micro things seem to be outside of the radar of the current administration. So it may be that growth will not only continue to be a problem, but may become a bigger problem as this shift of resources towards the government may actually increase these micro distortions and these institutional barriers to integration and growth.
Thank you so much, Augusto. Before opening to questions, is there anybody in the remaining panel that would like Guillermo, Laura, Roque, Guillermo Perry? Okay. The microphone is coming. Then we'll open to questions.
I think the bet of the government of trying to improve exploration and oil production may be sensible because there has been a major reduction in production of oil, and oil continues to be very important fiscally, especially because Mexico doesn't have a wide tax basis. And obviously, another option is doing a tax reform that it makes a more a wider basis for taxation of VAT or income taxation or whatever. But the problem is the way they are going towards this issue of promoting the oil sector. Because the previous government, what was trying to do was precisely as Pemex, as a public enterprise with a virtual monopoly, had not delivered. The fact is that Pemex had not made major findings either of oil or gas in a very long period of time. Then it doesn't, what they were trying to do was improving the corporate governance of Pemex and shifting some of the exploration and investment in development of fields to private companies, which seemed a sensible solution. It had not advanced too much, to be sincere. It was just beginning. And the problem is something that seems sensible now to go back to a strategy that in the past did not work, that was have the monopoly of Pemex, again, is at least very risky, especially when the company is in a dire financial situation. All oil companies, public or private, in the world got into problems when the price of oil collapsed at the end of 2014, in October 2014. The price of oil went from $110 to $40, and obviously all companies that had been overspending in the good times got into trouble, all of them, private and public. But most private and many public did a major adjustment already. I could give the example of Ecopetrol, the state oil company in Colombia, that at the beginning got into red, obviously, and just 2 years after, with a major restructuring, is again producing profits and taxes and tax revenues for the government, especially because the oil price improved again somewhat towards $65, $70 per barrel. So really, Pemex has not done the job. And betting all the eggs in a company that has not done the job seems a very risky proposition. And it also seems a little bit contradictory with the idea that you want to improve inequality and that you want to reduce corruption, because what is happening is that AMLO is, to keep the fiscal balance, he has made cuts across the board of 10% in all sectors, including health, education, and some very basic social programs are suffering to invest more in oil in a company that doesn't have a good record, while that job could be better done in conjunction with the private sector. So it doesn't seem to be a good proposition. and also because they are undoing the corporate governance advances, so giving free hand to Pemex to do huge projects may not be the best way to reduce corruption either. So that was what I wanted to compliment.
Okay, thank you. Now let's collect a few questions. Yes. Yeah, first there, then there's another question there.
Hi,
And introduce yourself, please.
I'm Miguel Schloss. I have an investment company in Chile, and I was in the World Bank for many years. And I want to congratulate, first of all, to the group. This is an outstanding work. And what I am going to say is not meant to be a challenge or a jab on the chin, but rather what I wonder, given the circumstances and given the long period of lackluster performance, both of Pemex and the country, whether you are not thinking ambitiously enough. I accept all the ideas about, strategy and restructuring and feasibility studies and headcounts and all that. You are following a very engineering concept in a company that doesn't have the oomph, to put it in a different way, to actually act on these fields. And I wonder whether, thinking a little bit beyond the lines of what Guillermo Perry just said, whether there isn't a possibility, particularly of your group, which isn't even the government, to think big, put a challenge, think about seriously privatizing or limiting the monopoly of Pemex, creating competition, leveling the playing field between the private sector and the government, and creating new conditions for dealing with the petroleum sector, so that you align the interests between those who manage the sector with the kinds of things that you're proposing, so that in fact you have I'll tell you, the skin on the game to make these changes really happen. I'm not saying something terribly original. It has been done in a different sector, in the different times. In my own country, in Chile, when the monopoly of Codelco was finished, private sector came, the whole increase of production and increase in efficiency took place in the private sector, created pressure so that Codelco becomes also a bit more productive, etc. So the question is, now that we are in the 21st century, hasn't the time come for your group to challenge the authorities to align the top management that will manage these kinds of restructuring and so on with the kinds of things that you are recommending, so that they actually do happen and don't remain a paper plan? Thank you.
There was a question there.
Sorry.
Yeah.
Thank you very much. Alan Gelb, Center for Global Development. Thank you again for a very interesting discussion. I guess my question follows on from Miguel's a little bit, but Mexico is not the only country with an important resource sector which is failing to capitalize on that sector. This is a very common problem. And there is some research that suggests that there is some sort of crossover point, that countries with very strong levels of institutions like Norway can capitalize on these sectors much better than countries with poor levels. And so I'm curious on the view of the panel. Do you think that having oil and having Pemex is good for Mexico, or is it bad for Mexico? What are we really saying? Are we saying that Mexico should think of itself as being heavily dependent on Pemex and oil, or rather that Pemex is distracting attention from the creation of laws, capabilities, perhaps technical capabilities, which is necessary for Mexico to move into the 21st century fully? Thanks.
Thank you, Alan. Sara Calvo.
I'd like to make a comment on your recommendation and also the issue of privatization. Two things. First of all, there is a history of expropriation in Mexico that perhaps it has to be taken into account when discussing the likelihood of privatization. But secondly, private investors come and go too. When things change and they get better opportunities in the US for the oil sector, they will leave. So I don't know if it's a good proposition. And thirdly, I don't know how important it is, the stabilization fund that Mexico has. When it is in the hands of the government, and
I would like to make an exception for Venezuela, that the government took that stabilization fund. But it's much easier to build up the stabilization fund when the resources are in the hand of the government. So I think that when considering privatization, perhaps all these things should be taken into account. And lastly, and I appreciate the committee focusing on issues related to growth. How different is Mexico from the rest of the region? We haven't seen good growth performances in the region.
Okay, any other question? Yes, please.
Any thoughts by the panel in terms of the ongoing renegotiation of the natural gas pipeline contracts? Arguably, that's a worse situation because of the funds that have already been spent, and those contracts were signed under an auction process as opposed to the upstream development, which was also an auction process, but the funds had not been deployed at great length, at least not to date.
Yes, please. Okay, our answers are going to have to be very short.
Hi.
I know.
Philip Devereaux with Chevron.
Okay.
Two quick questions for you. First, what interest is there from the private sector in Mexico so far? I know that they'd renegotiated and opened up the markets and that there is talk here of privatization and opening that up, but what is the private sector interest? And then second, what tax policy reforms would need to come down from the government to make the company cash flow positive? Thank you.
And there is one more question there. Yeah.
Hi, I'm Diana Marrero with Foreign Policy Magazine. My question's pretty simple. What kind of reaction have you gotten, if any, from the Mexican government?
That's it? Oops, one more there, and well, I'm glad there's a lot of interest.
Barbara Stallings, Brown University and Tsinghua University in Beijing. I'm interested in what you think the signing or non-signing of whatever the new NAFTA is called will have on any of this process.
Okay. Oh, one more there. There's one more by Vito. Please introduce yourself.
Yeah, Victoria Nugar from the IDB. So it's not a question, but it's like more what you think about like the consequences of migration and like how this like changes in the US and the barriers are gonna cause to Mexico. I mean, because you've been focused a lot of Pemex, but I think that might have also consequences for the Mexican like labor market.
Okay, Vito?
Vito
Tanzi.
Vito Tanzi. A kind of maybe agnostic question. You know, the more I read about economic growth, the more I read about the mystery of it, you know. But somehow we economists seem to look for indication that should be connected to growth, you know, more investment, more growth, oil, more growth. Well, oil, for example, must grow to make a country grow. You know, if you have a lot of oil but it doesn't grow, there's no reason why the country should grow. You know, if you have a lot of corruption in a country, this is a big problem. If you have a regulation which are the wrong one, I'm for regulation, by the way, I'm a regulator, but if you have the wrong regulation, and all these things seem to exist in Mexico, so why are we surprised that the Mexican economy has not grown?
Okay. All right. So you have put on the table many questions, and we are trying to address them as much as we can. We have 10 people, so we should be able to answer most of them. Just one clarification for the question about our conversations or reaction from the government. Let me tell you that you're the first, this group is the first in having access to the statement. The statement will be published immediately after the conference. So this is an independent group, totally independent, and so far there has been no reaction from the government. Let's see what happens. All right, so first let me start with the group that is not sitting here. Anybody wants to take any of the questions? No? All the work for the 50% of the people sitting here? Okay. All right, so let me start with you.
Okay.
Because I think you have a,
Yes. Actually, it's a good thing. I think 3 or 4 of the questions come back to an important point that distinguishes, for instance, Mexico from Chile, and particularly in the current historical context. Times have changed in Mexico for the possibility for market-oriented reforms, essentially, they're out of the window. So you have to work with what is feasible today. So yes, I think conceptually or theoretically, I completely agree with you, and I think a model like the one in Chile, where there is a large chunk of the production that takes place privately, a chunk of the exploration, a chunk of the production, and it coexists with a relatively sizable government part, it would be a good model, but there's no way. So I think about what is doable today in Mexico. The problem in Mexico that distinguishes these kinds of things is that we went through better part of 30 years of policies that privatized, the policies that deregulated, the policies that oriented, that pushed the economy towards market-oriented reforms. They did not produce the outcomes in terms of growth, in terms of reduction in inequality, and there has been massive corruption. So the discontent that the Mexican society had with the last regime was essentially about the complete cynicism with which all kinds of corruption that Mexico had came back in force. And this comes back to an institutional weakness. The problem with a lot of these ideas is not that in the paper, the energy reform, as I mentioned, a lot of the things that we postulated to do are already in the law of the energy reform that has already been passed. We started with the auctions for these contracts. The reform had a very bad luck that happened at the same time of this 2014 oil price collapse. So then it stayed sort of languishing because there was no interest. But then when the interest came back, there's a lot of corruption in the management of these contracts. So in the context of today, it is difficult, even the proposals that we're seeing, to go very far. So maybe I'm getting ahead of myself. What the government going to think? There's going to be this idea that we are fifi, neoliberal, ITAM type Mexican economies, and or international economies, just like the regime called the trading agencies or the rating agencies agencies of imperialism, or something like that. But you have to think something practical. We're trying to think things are there, the laws are there, and if we can think about a way to going back to them and making them work, that's probably has a better chance of working than something bolder. I think something bolder will be great if we were in a situation where politically something bolder will work. And it comes back also to your point, why is it different from Norway? Why is it different from Chile? Well, because in Mexico we tried a lot of this co-participation. We're pushing towards a large participation of the private sector. And corruption hit a lot of the potential benefits of it. And the corruption stands because the judiciary system is weak, because the enforcement of the rule of law is weak. And that is really, when I see where the big hopes from the Mexican society are with the current government, it's about the potential for fixing those big problems that are underpinning a lot of these economic frictions that we emphasize.
Yeah, and to complement on Alan's question, one has to remember that in terms of export, Mexico has diversified a lot, much more than many of the other commodity exporter countries in the region. It's still dependent on the fiscal stance for revenue collection, but not so much on the external sector. And that's a big difference from Mexico from the other countries.
One very quick thing.
Yeah.
So the point about the context, so the point that you raised is an example of what has been going on. The expenditures that were already in place, the airport is the most gigantic example of that. 40% of it is complete. That airport has feasibility studies. As an economic idea, it's a good idea. Implementation of it was flawed with massive corruption in the contracts. Fine. But the airport in itself, as an economic idea, it's a good idea. The airport in itself is 40% finished. Changing it for this idea of this airport in Santa Lucia, which we don't have good studies for, which is not a good idea, out of the political notion that everything that happened under the previous administration is bad, it's a bad idea.
Paulo has something to say too.
No, I think, thank you, Liliana, and for the question. I would say it has to do with the oil sector. Just looking at it from a broad perspective, I would say the oil wells, they're neither good or bad, they're there. But obviously they're a tremendous source of natural resources and wealth for the country. I mean, and you can run it like Norway, and have a huge upside for the country, or just think in terms of PDVSA. I mean, I think in terms of the administration of Sosa Pietri and Giusti, it was a great company with a lot of defects, with a lot of politics, but it was generating increasing production, a lot of revenue. So really, it's about the people that are there, and I think that Pemex, I think, it has incredible assets, but not all of those assets, make sense for the Pemex to be running. They could be running many parts of that, hopefully in competition with the private sector. But I do agree with Enrique that I think that the framework of the energy reform, I think, provides already a fairly decent framework that, if implemented, could give that context for reorganizing that company and getting the best out of the assets that they have, with the least possible losses and corruption, possible in that company. But I would say, I think Pemex is an asset, but I think if we're not careful, it will become a very heavy liability for the government very soon.
Pablo?
Yes, just simply the question on migration. We as economists, of course, do not have expertise to enter into the humanitarian aspects of the problem. What we see certainly is that is a big problem for Mexico. It has generated increased tensions with the U.S., and the way in which these tensions have been resolved or reduced, what we see is that it's creating actually also a fiscal problem for Mexico. And what we are kind of surprised is that the estimation of the fiscal costs of maintaining the migrants in the border and ensuring the security with the National Guard have not been estimated, and we see that that is may not be a negligible number that adds to the fiscal fragility that we have been pointing out.
Augusto?
Just perhaps to elaborate on Vito's concern about the mystery of growth, which seems to be precisely that, a mystery. I think that if there's one thing we have learned about growth, is that there is no one size fits all, and that the explanations for why different countries grow and others don't are difficult to grasp. But recently, with my colleague Alan Ise, we looked at some data, and I was really shocked by the fact that when you look at the post-war growth performance, there's a very strong association between growing and increasing the presence in international markets of your exports. So if you look at the share of global exports a country has and growth, you see very strong association that those emerging markets that have taken off typically have increased their presence in global export markets. The Mexico is a puzzle because it's a country that has increased its presence. The share in global exports that Mexico has risen steadily. And yet you don't see the growth that typically comes with that type of export dynamism. Now, when you look at Latin America, as we were saying, Latin America as a whole has a growth problem, but some countries have done better than others. And so you have Chile and Peru, for instance, doing well. You look at the share of global export, Chile and Peru, it has been growing. Costa Rica is doing well for all of its macro problem, and it manages to find niches in international markets. Panama, of course, is doing well. So one hypothesis we had in the discussions was that maybe in Mexico, these micro issues bite more. Because if you are Ecuador, you have shrimp and oil and banana and coffee, somehow you can find an expansion of your income by selling those few commodities in a sensible way. But in Mexico, since you are trying to be part of a very sophisticated market for goods, the ability of that effort, of that export effort to lift your economy seems to be highly constrained by these micro issues. that bite more in Mexico perhaps than they do in my country, in Ecuador. We have the same micro problems in Ecuador, the same distortions, and yet we seem to be growing better than Mexico. And maybe it's because we have some commodities to sell. Mexico is in a different market, where these micro and institutional issues, contract enforcement issues, regulatory issues, bite more, matter more, and in some sense, this is kind of a, in some sense, having commodities is a blessing, in that sense. And being in a sophisticated market, you need to actually get your institutions in better shape.
Okay, I think we've passed the time of the meeting. So I want to thank you, all of you, to join us. And hopefully we'll see you again in our next statement, Statement 42. So thank you to all of you.